Today's so first of all, happy new year to all of you all the very best for the new year from myself and on behalf of the institute. I would like to wish everybody all the very best. So today's session is on Islamic banking advances and facilities. So I presume you all have downloaded the slides. Everybody has slides. Okay, so to start with, we will understand why this the rationale to include this in the advanced diploma for credit management is there are two reasons why you should be interested in this session. One is that there are deposit-taking institutions in the country, around 15, 16 deposit-taking institutions in the country, which are involved in Islamic banking products and services. So if you, in case, sit in the credit department of any of these institutions, chances are you will come across some credit memo or some proposal related to Islamic banking facilities. As such, you should have some basic understanding of what these Islamic banking products are, what kind of risks they have, and what kind of, from a perspective, how do we handle them, right? That's the more important or primary rationale why you should be interested in this. Even otherwise, internationally, Islamic banking is a growing market, so there is always opportunities elsewhere. So that is also another concern, another reason why you need to know basics. You don't have to become an expert in Islamic banking, but at least you should know some basics, what is going on. The other rationale, of course, is this particular area is also an optional question in your exam paper. So when you do the exams in 3 or 4 months, or maybe around that time, you may have an optional question on this area. So if you are interested in attempting that question, it just gives you an additional option to look at it also. So that is another reason why you should have a look at this, and perhaps if you're interested in doing it, but it's an optional question only, it's not a compulsory question. So if you're interested, you could do the question too. Right, having said that, now let's move on to the slides. So the slides from here onwards, we process in a sequential style, in the sense that we go like a train. First the engine comes, then the compartment 1, compartment 2, something like that. So here in this case, the entire presentation is structured with, initially you can see on your left some symbols starting with I, which gives you information about the Islamic banking related subject. Then there is like a paperclip icon, which is the processes involved. Then there is a toolbox icon, which is the nuts and bolts of Islamic banking, especially credit related aspects. Then some rules of Islamic banking is presented under the star and crescent. Then we talk about related to Islamic banking under the red shield. Then we do questions. There are questions, examples, caselets in the slides, which we'll be doing. Then there is a reference point where it's symbolized by a book. Of course, reference, I think in the final slide, it's not there, but you don't have to worry about it. I'll provide references if needed. Then, of course, we talk about the examination, which is the medal at the last symbol, which is, of course, you will be very much interested in knowing about the what part of this comes to exams and how we handle it. That we will talk throughout the session. Anybody has any questions in between, please feel free to talk. If you raise your hands or something, I don't know whether, yeah, if I see it, definitely I will attend. Otherwise, please talk. Feel free to stop me. If you don't understand anything, I'll be more than happy to repeat. Right. So the session is structured in this manner. Initially, we will talk about Islamic banking, an introduction. It will take a little bit of time where we define what Islamic banking is, what are the key principles involved, and what are the philosophies involved in this type of banking. Then we look at predominantly on the facility and credit and advance side. So we will look at the facilities for businesses and facilities for individuals, and we will conclude. So this session and the next session, we will be trying to complete all these areas in the slide. So this is a unique experience for me also, because it is on virtual environment, so there is no direct feedback, but please feel free to discuss, clarify anything you all have in your mind, anything you don't understand, please feel free. So with that, we move on to introduction of Islamic banking. So essentially, I'm sure you all have access to the slides. Please have a look at the slides. Wherever I need to write anything on the board, I will switch on to the view where you can see the board and discuss. So for the moment, I will continue on this. So we start by, at the outset, we define Islamic banking or Islamic banks as financial intermediaries that operate within the principles of Sharia, right? That's how we define it. It's a working definition of Islamic banks. So it's a easy way. So in any case, you have to write about Islamic banking. You start with the definition of what it is. This is what I would use easily. There is more detailed definition on the third bullet. You can use that also, but this is very easy to remember: financial intermediaries which operate within the principles of Sharia. So there are three keywords there: financial intermediaries, operation, and principles of Sharia. Each one of them we will try to understand a little more as we go on. So as you all are familiar with, you all are students of advanced credit management. You all are familiar with the concept of financial intermediary. Financial intermediary is let me switch to the screen. Yeah, so financial intermediary. Can you all see me? Hello, can you all see me? Can you all see me? Can somebody respond, please? Hello? Right, okay. So initially, we defined Islamic banking as financial intermediary which operate within the principles of Sharia. So in order to understand that, I will just draw on the board if you all can see. So in any economy, so in this, we have surplus unit on this side, we have deficit units on this side, and the financial intermediary is in between. And any financial intermediary has the primary job of matching the surplus units with the deficit units. That's the key role of financial intermediary, or in other words, we call that asset transformation. In addition, so when financial intermediaries borrow from surplus units, it's called the deposits. When financial intermediaries lend to deficit unit, it is called the advances. So deposits or loans and advances, we call them. So deposit on one side, which is surplus units, funds to financial institution, and financial institution giving funds to deficit units. That's the key financial intermediation process. On top of it, you have banks, banking services provided by financial institution. So that is non-fund based banking services. Banking services which are non-fund based, so it is not fund, it is fee-based services provided. In addition to that, the financial intermediary also manages its own asset and liabilities. So that is, in broader sense, what a financial intermediary does, and we all know about this. Why it is important to start from here is that conventionally, financial intermediaries do this function, that is either accepting funds from the surplus units or giving money to the deficit units as based on interest. So you accept deposits on interest. So when I go and deposit with a conventional bank, I get a interest. So the bank will tell me, I will pay you 3% on your savings account or 5% on your FD or something like that. And when I go to okay, so there is a question about whiteboard be mirrored. Can you all see the whiteboard? I thought it is being mirrored. Okay, so right, that's great. So going back to what I was saying, so essentially financial intermediaries do this channeling of funds from the surplus units to the deficit unit using interest-based transactions. And so if that is the prime function of financial intermediaries, and how could there be something called Islamic banking, and where is if it is interest free, how can you do Islamic banking without interest? That's the general question. So the answer to that is what we are trying to address here. So we start from a position you can engage in financial intermediation process even without having interest-based transactions, even without accepting deposits based on predetermined interest or giving facilities based on predetermined interest. So that is where we start. The Islamic banking. That's the start of Islamic banking. We will discuss that in a little more detail. So essentially, the financial intermediation process in an Islamic bank will happen based on non-interest based transactions, right? Why is that? What is the philosophy behind it? We will discuss as we move on. So we define this financial intermediation process, which in conventional bank, both on the surplus sides and on the deficit side, happens on the interest-based transactions. So the essence of the Islamic banking philosophy behind it, let's look at it a little more clearly. So in any economy, we can identify around 5 sectors or 4 sectors in broad. One is a real sector, the other is external sector, fiscal sector, and monetary and monetary and financial sector. So that in any economy you can categorize the sectors in an economy like this, maybe 5 or 4. So real sector is related to the production, investment, consumption of the sector of the economy. External sector is related to trade with the rest of the world, investments and things like that. Fiscal sector is the government's operation, the income and the expenses, the government, its investments. And then the financial sector is related to the banking aspects, the conventional, the borrowing and lending aspect. So the conventional transactions in conventional banking will be on the financial sector, where we borrow and lend money, right? Of course, it could be it could have some it could be related to what happens in the real sector or external sector, but it is not directly linked in general. So in Islamic banking, we try to link the financial sector with the operations of real sector. When we say we link, if you borrow and lend money on the financial sector, that is the transaction will be more like loan transactions. If you connect to real sector, if you connect to imports and export, or if you invest in infrastructure projects of the government, and you use transactions like sale or partnership or lease, things like that, your transaction becomes more connected. Okay, you all can see. I have a comment, can't see anything. Hello? Main window disappeared, okay. Can you see? Right, good. Good. So essentially, in any economy, when we link the real sector to economic sector, real sector to financial sector, we can do that using contracts like sale contract, or lease contract, or investment or partnership contract, which is much more linked to the real sector than just lending or borrowing. We will discuss that point as we go further into the specific products. But the point here is that is the essence. This link between the real sector and financial sector lies at the heart of Islamic finance. So that is the real link from which the philosophy or the products come from. Because the philosophy behind it is that in order to create discipline finance or financial discipline, the finance should be always connected to the real sector or external sector or fiscal sector, something like that. There should be link. Finance cannot on its own exist just lending and borrowing money without that connection. That's the philosophy. And that connection is sometimes known as the financial discipline, because if you disengage the connection between the financial sector and the real sector, there could be situation where grows beyond a certain level where it's no longer sustainable. And in those days, when these principles developed, old days, people who borrow beyond their means, beyond their economic activity, beyond their capacity to repay, they end up being slaved. So as such, the principles of Islam are strongly against such principles. So it stands for if that link is not properly done, it doesn't mean that every time you borrow on interest you become enslaved, but the system which operates without link to the real economy could lead to a debt trap at an individual level, at an organization level, even at a country level, which is not healthy, because the individual or the organization concerned may become stressed out, may fall into the fall into a trap which is difficult to come out from. As such, it should always be linked to the real sector activities, and the link to the real sector activities is transactions such as partnership, such as sale, such as lease, which always has some asset backing in it, so that it's always linked to the asset. So that's essentially what the thinking behind these products. So instead of doing the loan transaction and creating financial intermediation process, we do alternative transactions such as partnership, such as sale, such as lease, which will allow us to create these links with these sectors more closely. So that is where the initial point of departure of Islamic finance from a conventional finance focus looks at. Because in conventional finance, we could increase the financial sector, or we can increase the loan and borrowing, although it may not be very prudent to do, to the extent that it doesn't necessarily need to be connected to the real sector. So even to repay another debt, you may be able to borrow. Whether it is sustainable or not is a secondary question. But in Islamic finance setup, unless there is some asset back, this will become, it will be restricted to certain extent, right? So that's where the initial philosophical philosophical principles related to Islamic finance start from. So because people who get into this debt, unsustainable ones, will lose their freedom, will lose their honor, will lose their assets, it is vehemently rejected not to use that. So loan in that sense is only as a benevolent contract. You give a loan, you get it back, nothing more, nothing less. But having said that, I do not want to give you all the wrong impression. Islamic finance is cost-free. It is not. It is interest-free, all right, but it is not cost-free, because the transaction that is used to link the monetary sector with the real sector, those transactions, such as sale transaction, such as partnership transaction, can generate a return, and that return could help the financial intermediaries to earn a return. So since by definition financial intermediaries channel the funds from the surplus units to the deficit units and return it with the profit to the surplus units, it's not a charity. So the funds go back to the original surplus unit with a return. As such, it's different from charity. So some of the misconception, Islamic finance is interest-free, it should be cost-free. That is not true, because why it's not cost-free is because the underlying transactions used in Islamic finance create returns for the providers of funds. As such, it is not cost-free. Number two, it is not charity because of by definition financial intermediaries cannot be charity, because they accept somebody surplus units money on the promise of returning it back. As such, it's no charity. So going back to the slides, the slide says in general. So when we say financial intermediation process, in general, easy way to think about it is to say borrow at low interest, lend on high interest, and make money in between as an intermediary. That is one way of looking at financial intermediation. The other way, which is highlighted as the point from Miskin and Eakins, is that you can view financial intermediaries as selling liabilities with one set of characteristics and buying assets with another set of characteristics. The characteristics can be when you are selling liability, you sell at low interest rate. When you are selling asset, you sell at high interest rate. When you are selling liabilities short term, when you are selling assets, you sell at, when you are buying assets, you buy long term. So that in between you create the margin that is the intermediation cost or the spread of the financial intermediaries. So rather than only looking at borrow on interest, lend on interest, as long as you sell set of liabilities, liabilities with a set of characteristics, and sell buy assets on another set of characteristics, by matching them, if you could make a spread, then we could create financial intermediation process even without having an interest-based transactions for financial intermediation. And that's where that's how Islamic banking is structured. So on the deposit side, Islamic banking sets out a whole lot of yeah, just going back to the slide. So I hope you can see. So on the deposit side, Islamic banks take deposits on profit sharing basis, and on the advance side, we will look at different types of transaction in our discussion, like the sale based, like a partnership based, like a partnership based transaction, like a sale based transaction, and similar transactions, which will allow financial intermediary to make a return on the funds, on the advances and facilities, right? So going back to our definition, we started defining Islamic banking financial intermediation process within the principles of Sharia. So I want to clarify what I mean, what is meant by principles of Sharia. As we go on, we will discuss that. But in general, it involves so the application of Sharia principles is generally decided by a group of Sharia scholars in each of the financial institutions. They are called Sharia Council. They determine the application of these principles in the modern context. So we will come to that as we go on. So that is also something you have to know. So moving on to the next slide. Any questions you all have on the previous slide? Can everybody see? Okay. Going back to the next slide, we are talking about the key stakeholders and the different types of disciplines, disciplines that are involved in Islamic finance. So to start with, we go to there are three different type of stakeholders, key stakeholders in Islamic finance. One is customers. They come to Islamic banking looking for a particular set of values and they meet their customer requirements. Number two, the legal and regulatory framework, which is the law of the country, which we need to ensure we comply to, we abide by. And three, the principles of Sharia, which we need to ensure that those principles are not violated. So in essence, any Islamic bank has to ensure that it meets the requirements of the customer, needs of the customer within the legal and regulatory framework of the country while ensuring adherence to the principles of Sharia. So although it is easier to say, it has to be done very carefully. It has to be done that all the principles of Sharia, all the requirements of customer, and all the laws and regulations of the country satisfied, ensured in delivering the services. So if these three are not in alignment, so if these three are in alignment, we show in this diagram that is on the slide, that on this particular slide. So we show this diagram that quadrant D, so framework to understand Islamic banking, I'm on that slide. So if we are in quadrant D, in that we will be able to sustainably grow or sustainably operate Islamic banks. So if you are in quadrant A, B, or C, which is not a perfect place to operate in, you will have it's not a sustainable way of operating. As such, there could be issues, there could be challenges. So if we operate in quadrant A, that means we are meeting the customer requirements, we are complying with principles of Sharia, but the laws and regulations of the country are not specifically adhered to. That is a situation which is not sustainable. So it is not something you can continue to do. Similarly, if you are in quadrant B, you meet the requirements of the laws and regulations, you meet the principles of Sharia, but you are not meeting the requirements of the customer. So if you don't meet the requirements of the customer, chances are you will not survive as a organization. Similarly, if you meet the laws and regulations of the country, you meet the customer requirements, but you cut corners on the Sharia principles, the customers who are interested in Sharia compliant solution will not be coming towards the organization. So that also is not sustainable for an Islamic bank to continue like that. So the challenge is to all the key principles, all the aspects of this framework are adhered to, and that is the challenge for Islamic bank. So ensuring, but having said that, it's not sometimes easy to implement this. For instance, certain concepts which are inherent to Sharia may not be used commonly in practice. So in certain cases like that, where there are diversions. So as an industry, the Islamic banks have tried to evolve and try to accept how these can be work together, how this can be improved, how this can be combined to ensure we get the best out of we ensure that compliance in all three systems. So that challenge, by meeting all the regulatory requirements, by meeting all the Sharia requirements, and meeting the customer requirements, the challenge remains a key challenge for organizations to operate throughout. So now we move on to the key principles of Sharia. So what we said at the initial stage is that Islamic finance is Islamic banks are financial intermediaries which operate within the principles of Sharia. Having said that, if they operate within the principles of Sharia, we need to understand what are those principles. So this slide summarizes some of the key principles, and as such, you will be able to understand what these principles are and what they stand for. Right. So we will cover them one by one. And what I will do is I will explain what those principles are, and then what are the implications of those principles for conventional banking. So that's how we will move from now on. So I have put down 7 principles. The first principle is the concept of permissibility and non-permissibility. The first principle is the concept of permissibility and non-permissibility. So, so as with any religion, Islam has certain values, certain things that it permits, and certain things that it doesn't permit. So, so its value system, there is why it is so is based on its value system. So it's like driving on the road. In Sri Lanka, we drive on the left. In some other countries, we may be driving on the right. That's the value system. So similarly, we have a value system. So Islamic banking has certain value systems. Certain things are permissible, certain things are not. So in business, there are certain things which are listed as non-permissible activities. For instance, alcohol, tobacco, gambling, certain types of adult entertainment, things like that are not permitted in Sharia. So those are not acceptable. As such, Islamic banks cannot give facilities for these type of operations in general, right? So it is like in banking, in credit policies, generally we have certain negative list, right? Or so we have a negative list, meaning there are sectors where we won't lend. It can change from bank to bank. There may be policy. In old days, it used to be we don't lend to gambling places, or we don't lend to casinos. So that is put in credit policies, which means this sector is not a sector that we will lend to. So similarly, but that decision, conventional bank, that decision is based on the rewards of the sector, right? A sector which may create legal trouble, or a sector which reward is not acceptable to the type of risk, we will put it in the negative list in our credit policy, saying we won't do this business because we don't have the capacity, or the risk that we take is too much, or regulatory wise they have lots of non-compliance risks, something like that. So we spell out these industries in our negative list in a credit policy. But here in this case, these are also negative list, but these are based on the values. So this doesn't change irrespective of the risk return trade-off that changes. But even in conventional banking, some of these companies become non-acceptable. But only difference is that the conventional banking negative list is based on risks and rewards. So let's say when small, unregulated or unknown entities are operating casinos, it will be on the negative list. But if large blue chip companies start operating casinos, maybe the credit policy will be reviewed. Maybe we will look at it and see whether we can incorporate it. That will be in a conventional banking side. Because if they become more regulated, more familiar, and more prominent in an economy. But whereas here in this case, Islamic banking, when they put in their negative list, it is put based on some values. So irrespective of how big the sector comes, you will not be able to accommodate, because these are value-based sectors. So the first principles of permissibility and non-permissibility is based on the values inbuilt in Islamic banking. So the implication of that is we will not be able to lend to certain sectors, such as the breweries and distilleries and alcohol manufacturing companies, that kind of sector, tobacco, and similar sectors, weapons. These type of sectors generally are not acceptable in Sharia, right? So that is what the first principle means, and that is what the implication is, that you will not be able to lend, give facilities for these sectors. The second concept is the concept of prohibition of interest. So in Sharia, the interest is defined as, everybody's clear so far? Any questions? Any questions? Everybody is clear? Okay. Right. So in Sharia, interest is defined as any excess paid on a loan contract that is conditional to that contract. Any excess paid on a loan contract that is conditional to that contract. So any loan that I give, and if I define that you need to pay me back with an additional interest, additional amount, that goes as interest. So underlying contract, if it's a loan contract, the Sharia view is that you need to pay back the capital. That's it. Irrespective of how long it takes, you need to pay back the capital if it is underlying contract is the loan contract. But you can have a return if underlying contract is profit-making contract, like a partnership contract, like a sale contract, like a lease contract, like an investment contract. Those are different. Those you can get a return, which we will see as we go on. But if it is a loan contract is treated as a gracious contract. Okay, slides are not visible. Good. So we continue with the slides. So we were discussing about prohibition of interest. What it means is that any interest from Islamic banking perspective means any excess loan contract that is conditional to that contract, that is interest. So any loan we give, we cannot charge any excess. So what it means, the implication is that the conventional banking's deposit taking activity and advances becomes unacceptable in general to Islamic banking, other than certain type of operations like the current account and things like that. General interest paying, deposit taking activity, or giving advances on interest becomes a problem in general. The third principle is so any interest. The second principle is that any payment or receipt of interest is not acceptable. Not only that, you shouldn't receive interest, you shouldn't pay interest also. As such, it is not acceptable. Third principle is principle of uncertainty. So principle of uncertainty means that the contract should not be vague. Contract should not be vague, and we should be clear about what type of contract we are getting into. So what it means is that certain features or certain characteristics of contract, such as the price, such as the delivery date, things like that in any contract, has to be very clear. The subject matter of the contract, where there is vagueness in that delivery, that could lead to problems, as such not acceptable in Sharia. So what do you mean by vagueness? For instance, if you are going somewhere and you want to hire a vehicle, you should know what price he will charge to reach that destination. Okay, display is unavailable. Is it okay now? Somebody says displays on okay, good. So in general, if you say uncertainty, what we mean is the price, the delivery date. So if I'm going to a place A to B and I want to hire a vehicle for that, I should know what price I will pay either to reach there or per kilometer. I can't just say, okay, pay me some price and get into that vehicle, because after I get down, if there is a dispute, it's not easy to solve that because we didn't agree on price properly. So what is the implication of this contract prohibition of uncertainty and gambling is that certain contracts which doesn't define either certain aspects of contract, certain aspect of a transaction, for instance, delivery date or price or things like that, become unacceptable in Sharia. More notably, contracts like forward contracts are not acceptable in Sharia because of this principle. Because forward contract, you don't deliver anything today, you agree to deliver both sides of the transaction on a future date. As such, it is not acceptable. So the implication of this contract, so contract prohibition of uncertainty doesn't mean change in, there should not be change in returns. That is not what is meant by prohibition of uncertainty. What it says is the underlying contracts has to be clear. There should not be vagueness in contracts. That's what it means, right? So the implication is certain instruments such as forward contracts or options and credit default swaps and transactions like that become unacceptable from a Sharia perspective. Principle number 4 is restriction of sale of debt. So restriction of sale of debt means if there is any debt, a debt can be transferred only at the par value. It cannot be transferred at a premium or a discount. So any debt has to be transferred only at par value. That's what it means. So in general principle, of course, when I say restriction, as these are exceptions, right? Exceptions. So in certain jurisdictions it is possible, but in majority of the jurisdictions, sale of debt is not allowed. So what it means is general banking business such as bills discounting or check discounting or discounting of other instruments will not be acceptable, because if we are discounting, the essence is that if you are transferring debt, it has to be only done at par value. So that discounting is not very, this principle doesn't allow the conventional operation of discounting. So there is restrictions on that. So sale of debt means any debt. So these are referring to book debt. So if I write a IOU, that is a debt. If I write a check with a post-dated, if I write a post-dated check, that is a debt. And even in legal terms, there may be restrictions on writing post-dated checks. That is a different aspect here. This is the Sharia term we are talking about. And these principles don't encourage discounting or selling debt. So what is encourages sale of goods and services and things like that, but not of debt, because that leads to interest in a backdoor sort of way, as such not permissible. Principle number 5 is restriction of buyback. So if I sell something to A, I should not buy it back from the same person immediately after selling on a different term. So immediate or simultaneous purchase and sale of same goods, one side on spot basis, the other side on deferred basis, something like that. So if I'm selling my pen to you, I sell it at 100 rupees. I can buy it back from you, but at 100 rupees, that is fine. But if I sell the pen to you at 100 rupees, try to buy back it at 120 rupees. That is in general not a buyback at 120 rupees after 3 months or 8 months or whatever. That is not permissible. So what it means in nowadays is that so the transaction that looks similar to the buyback is the swap transaction in modern terms. So swap transaction is simultaneous buying and selling of the of a instrument, one on cash side, the other on deferred side. So transactions like swap are not acceptable based on this principle. So that is restriction on buyback. Then the 6th principle is concept of risk for reward. Concept of risk for reward, which means if I am to be rewarded in a financial transaction, we need to take some kind of asset or goods risk, price risk. You need to take some kind of risk related to ownership of underlying investments, which justifies the rewards for that. So if you so the risk here does not include the credit risk on a loan transaction. So we can't claim in general, I took a risk, the counterparty risk or credit risk on this loan, as such I'm gaining a return because it's loan. Then the seventh principle is the general principles of fairness, trusteeship, and justice. So in general, so this is a catch-all phrase or catch-all principle where generally we had to be fair to everybody, every stakeholder in a contract, in business, and you should not do any injustice to anybody in financial transactions. Not only financial transaction, the principle is broad principle, but as far as we are concerned, in the financial transaction, we had to be fair by all parties. We should not be unfair. And the principle of trusteeship comes from a concept of dual ownership inbuilt in Sharia, meaning all the assets, all we inherit other properties, and we will use it for some time, and when we leave this world, we will give it to somebody else and move on. As such, we are just trustees for a short term, maybe 50 years, 60 years, 70 years, and we move on. As such, we should act with grace, act with consideration for everybody around, rather than being too selfish. That's the trusteeship part. So these are general principles which any corporate, with respect to Islamic finance or whatever, would be interested in following. So when we say Islamic finance is financial intermediation, with financial intermediaries that operate within the principles of Sharia, the 7 Sharia principles, although this is not an exhaustive list, this captures a large majority of principles that we will face when we do Islamic finance. And these principles, if you carefully look at it, to some extent were inbuilt in even in the legal systems in years gone by. For instance, even in US, trading of derivatives was prohibited until until early 1990s or early 1900s, something like that. So bills discounting, for instance, is not very check discounting, for instance, post-dated check may not be in line with the current law, right, or however outdated it may be. So there are some of these principles are common sense. Some of these principles are not only held by people from Islamic faith. It may be common to other faiths also. It may be common to it may be sometimes sound banking principles also. So although I have put key principles of Islamic finance, some of these principles are not necessarily only Islamic finance. It is maybe general, but perhaps boring side of banking, more cautious side of banking than more aggressive side of banking. So as such, it's worth looking at it from that perspective. Anyway, some of the principles of Islam are shared by the Abrahamic religions like Christianity and Judaism. So it's not only common to Islamic banking. Having said that, okay, display is unavailable. Let me try again. Can you all see the screen? Can somebody respond, please? Okay, thank
Yes,
you.
I can see.
So going back, any questions so far? If you all have any questions, you can type it on the message or you can unmute and talk. Any questions you all have so far? So I think with that slide, we have covered the basics of Islamic banking, what it means, a definition. So we started with the definition saying Islamic banking is financial intermediation process within the principles of what key principles define financial intermediation and how Islamic banks do it slightly differently, right? Without using loan-based transactions. So we will now go into details of seeing what are the transactions these Islamic banks use in giving facilities. That's the next step. So before we move on, any questions you all have, I'll be very, very happy to answer. Right? Anything you all have? Okay, since no specific questions, we will move on. So we have first completed the introduction. Now we are going to discuss about the facilities for businesses. That's the second stage. So in general, the business facilities can be provided by Islamic banks. There is no restrictions on that because giving facilities to businesses can be accommodated. So we have studied from our basic courses in credit that all credit we can split into two. One is for asset finance, the other is for liquidity purposes. So if you divide all the loans based only on purpose, there could be two purposes. One is for asset financing, the other is for liquidity purposes. In general, Islamic finance has a bias, right, towards financing asset purpose transactions, even commodities. So asset purpose, generally we think it's long term, but even short term, like buying inventory and things like that. Islamic finance has a bias, so it is standard contracts allow Islamic finance to fund those, but relatively less flexibility is there in case you need liquidity. So if you carefully look at Islamic finance transaction, liquidity products, for instance, an overdraft or a bills discounting or a pawning from a consumer side, or overdraft and bills discounting on the business side, will be less. I'm not saying it is not available at all, but it is less available or less used, because general bias is towards asset finance. As such, that needs to be taken into consideration when we do facilities for businesses in terms of purpose, right? Purpose, Campari, your standard evaluation matrix. You will remember purpose is one of the key things you will write about. If you are in credit, you will review it. So it has to be kept in mind. It has to be in your mind that generally there is a bias towards funding assets and inventories. So the amounts involved, how much can you lend to a particular business? It depends on the underlying asset in the transaction. We will discuss that as we go on, but we cannot give Islamic banking facilities for any amount. So generally, it is restricted to the underlying asset involved. As such, there will be a restriction on that underlying product involved. So even when customer's credential is good enough to give him more facilities, if the underlying transaction don't support, we will not be able to. You will not be able to give facilities beyond a certain level. So tenor, you can give facilities for short term, medium term, and long term. Pricing can be market based. You can charge fees. It can be fixed and it can be floating price, but depending on the contracts. So we'll discuss as we go on more. Right, and in terms of documentation, Islamic finance transaction will involve standard documentation. In addition to that, under English law, under the law of the country, in addition to that, product documentation specific to Sharia-related transaction is also used, right? So that is the documentation part. So if it is a partnership facility, which is called musharaka, there will be a musharaka documentation involved, in addition to the standard documentation. The other is in terms of collateral or insurance, you call it under Campari, or the collateral that you could take on a facility is anything. So you can take any collateral, and you can even give facilities without any collateral also. So collateral is not a condition of Islamic finance. Whether we have a collateral or not does not determine whether the contract is Islamic or not, right? So you could take any collateral. You could take a mortgage. You could take a lien over something. You could take a pledge. Any other contracts can be taken for Islamic finance purposes. So when we say Islamic finance is asset backed, what we mean is that we will give facilities for underlying transaction which involve purchasing assets. What we don't mean is, in order to give those transactions, we need to have a collateral of a property. Otherwise, we won't be able to give, right? So that is not what we mean. What we mean is underlying transaction. If I'm purchasing something, I'll be able to give, but it doesn't mean I need to have those purchased goods in as a pledge or as a mortgage. Repayment can be installment or bullet payments. It can vary depending on short term or long term based on the mutual understanding with the customer. Rescheduling is sometimes difficult in some transactions. Delays could also create trouble. So we will discuss that restructuring is possible in case-by-case basis. We will discuss product by product as we go on. Any questions now? Okay. So now we move on to the first product in Islamic banking transaction. It is called partnership. The word used, Arabic word used, is musharaka. You don't have to worry much about the Arabic word. It'll be always there in the paper or anything like that in English, partnership. But if you are dealing with customer may be using these type of words. If he is familiar with Islamic banking. So how from now on, how the lecture is structured is we will talk about each type of product. We will talk about the process involved. We will talk about the credit aspects of the product. Then you can have any questions you all have. You can please feel free to raise it either by or by speaking. Then there will be questions coming, right? There will be questions which I want you all to do, and once you do, we can do it on the board here, and then we can check ourselves how well we have done. So these questions will be the questions similar to the questions. These are the questions, similar questions only you will be getting in your examination. Of course, not the same question. There will be more detail in actual question in the exam, but this will be similar to what you're going to get in the exam. So it's worth looking at them, practicing them, asking whatever clarification you have, so that when we go to the question, when you finish, you're very clear about it. So I'm very open last of people. We can have more time. We can discuss specifically what you understand and what you don't understand. And I can do the question on the board once you all have done. That is, once we go through this, right? And any doubts you have, please feel free to raise those questions, right? So first product that we are going to look at it is called partnership. Partnership, and the Arabic name used is musharaka. So partnership, this is not the partnership of 1835 Partnership Act. This is a partnership as a financing product used in Islamic finance. Of course, there are a lot of similarities, right? So it is not the bank enters into a partnership agreement with somebody. It's not like that. It is a partnership facility which has partnership features inbuilt in it. Right. So in partnership, both parties contribute capital. When I say both parties, it is both the bank and the customer contribute capital towards the partnership. So capital is contributed by both parties. That is the first feature. So bank contributes a part of the capital, customer contributes part of the capital for a profit-making activity. Partnership cannot be done for non-commercial activities in general, subject to few exceptions. In general, all partnerships are for generating profit-related activities. So business transaction, only most of these partnership is done, right? So both parties contribute capital. Second point about capital is contributed by both parties. There is the bank and the customer. Identified as a specific project in general, right? Both parties contribute capital. Profit is shared based on a pre-agreed profit sharing agreement. Pre-agreed profit sharing rate. Profit sharing rate is also known as PSR. PSR, where both parties contribute capital and receive profits, let's say 50-50, or so both parties receive equal profits. 75 for the bank, 25 for the customer, or 25 for the bank, 75 for the customer. Whatever the rate you want to agree, that is permissible in Sharia, right? So as such, profit sharing ratio is agreed, pre-agreed. Pre means prior to engaging partnership, right? Pre-agreed. Loss sharing ratio, LSR. Now, loss sharing ratio is losses are shared based on capital contribution. So capital is contributed by both parties. It can be any portion. You can put 50-50, you can put 10-90 or 90-10 between the customer and the bank. That can be agreed, mutually agreed. So if you put 50-50 capital, the losses are shared based on 50-50. So if the bank puts 100 rupees, customer puts 500 rupees, if there is a 10 rupee loss, 10 rupee loss is shared, 5 rupees for the bank, 5 rupees for the customer. So based on the ratio of losses are shared. Losses cannot be pre-agreed on any different basis. It is a principle that the ability of capital has the ability to absorb loss. So loss is defined as loss of capital. As such, any loss has to be borne by the capital ratio. So capital, profit, losses, then management. In general, management is given to the customer. That is, bank does not get involved in day-to-day business of managing the partnership. So bank does not get involved in determining what kind of partnership operation happens, although it may get some reports of as a part of credit monitoring process. It doesn't get involved in management. Management is done by the customer. And the next point is about dissolution. Dissolution means the partnership can be brought to an end based on a pre-agreed time period. For instance, after 3 months, partnership ends. Or after 6 months, partnership ends. So pre-agreed time period, partnership can end. Partnership can end based on completion of a transaction. For instance, if there is a musharaka partnership with the customer to import and sell 5 containers and you distribute the profits or losses on the containers, partnership ends. So it can be partnership can come to an end based on the time period. And number 2, based on the completion of transaction, or Number 3, based on agreement between partners. Okay, now we have done this for 5 years. Now let's mutually agree to cancel. That can be also done. So in most cases in banking setup, it happens based on the time or based on the transactions. In general, Musharaka partnership is done as a Islamic banking partnership at 3 levels. One is for transaction, like I just said, for importing a particular type of goods and reselling, or a project level and organization. You set a new project agreement. Number 3, an organization level, especially diversified companies. Let's say a company has large amount of business lines, 5 business lines, 10 business lines. In order to enter into that business lines, at a treasury level, at a group level, you can have organization level partnership. So 3 type of partnerships are possible, can be implemented using the Musharaka. So let me go back again and explain it again. There could be partnership. First type of facility that we are talking about is partnership. Which is where both bank and the customer contribute capital. Profits are agreed at a pre-project or prior to starting of the project. Profit sharing ratio is agreed. So profit sharing ratio is a ratio, not a percentage. So it will add together to 100, maybe 50-50, or maybe 10-90 or 90-10. That's the profit sharing ratio. Then if there are losses should be strictly shared based on the capital contribution. You cannot share any other based on any other ratio. That is the losses. In terms of management, in general, bank does not get involved in managing the project. So it is always the customer who manages the project. So there is zero on the project itself, on the time, based on transaction, or based on any other pre-agreed mode. There are 3 types of musharakas. One is at transaction level, either to import or export or buy or sell anything, you can have musharaka. If an entity has 3 or 4 or 5 projects, one specific project can be a musharaka also. At organization level, sharing gross profits, you can have musharaka based on financial statements. For specific period, you can have musharaka also. Right? Those are the basis of musharaka. It can be implemented so that instead of giving loan to the customer, you can give musharaka and generate return. So in a conventional bank, we give loan and create return. Here we give funds as partnership funds and we create a return, right? We will look at this in later. So we move on to the next slide. This discusses the process. Let me explain that in the screen. So there are three IB. Gives funds project. Customer also contributes funds to the project. So this is the contribution of capital. This is the contribution of capital. Both parties contribute capital, right? 1 and 2. Contribution of capital. IB stands for Islamic Bank. Project. Customer, right? Both parties contributing capital. Agreeing on pre-agreed profit sharing ratio. Pre-agreed profit sharing ratio, right? So both parties contribute capital on an identified transaction, identified project, or for a period business transaction, right? And then once the project results come, that is after the agreed period, right? Project work happens after the agreed period. You share the profits or losses to both parties based on the pre-agreed profit sharing ratio. Profit sharing ratio, profits and losses shared with the customer, right? Profits and losses after the capital is received, the project starts its work. Once the project is over, profits or losses are shared between the bank and the customer. So that is the process here. So formation of capital, both bank and the customer inject capital. Work is undertaken, business or project or transaction is undertaken. Then bank receive the profits or loss of the bank of the process, and the customer also receives the profit or loss of the process, right? Any question you all have on this? No? Right, okay. So we move on to the certain rules related to certain principles or rules related to musharaka. First is it is not permitted to stipulate that a partner in sharika is musharaka. The word there is should be musharaka. Anyway, so both parties you can receive, like I said previously, you can receive any type of collateral. So if a corporate guarantee comes, you can accept a corporate guarantee also. But what it means here is that you cannot guarantee that the capital will be secure. Because when you say partnership is something, partnership is where you share profits and losses. So if you guarantee capital, that goes against the principles of Sharia, right? So if you guarantee capital, losses means loss of capital. So if there is a loss, you will lose the original amount you contribute towards the partnership. So if you guarantee that, and if you say you won't face any losses, then that is against the spirit of the transaction as such, not acceptable. There is also dual profit sharing ratio. So I said you can have a single profit sharing ratio. Going back here, we can use a single profit sharing ratio for 5 and 6, for 4 and 5. It can be 50-50. It can be 60-40 or 40-60 customer and bank, you can have any of the ratios, but what should not be the case, as understood, is that it can't be more than 100%, obviously. The other is it should not, it doesn't have to be only one ratio. You can have dual profit sharing ratio, and the rationale for that is if the business gets a large windfall profit on particular quarter, particular transaction, it may not be very keen to share it with the bank. As such, as long as banks get their return, they'll be more than happy to allow business to take its return. So generally, you bring in a clause where you say up to 1 million profit sharing ratio is 50-50. Beyond anything beyond 1 million, the profit sharing is very low to the bank and very high to the customer. So that is what dual profit sharing means. It's not very regularly practiced in Sri Lanka, but other parts of the world it is available. The other point is capital contribution could also be done based on offering physical commodities. So it doesn't always mean the customer has to bring in cash. If he is having existing business and his shareholders' funds is treated as capital. So capital can be in kind. The assets and the funds he has poured into the business can be treated as capital. The final point is about amendment of PSR. In general, PSR means profit sharing ratio. In general, profit sharing ratios are fixed. So there is no fixed at the start of the transaction. But if both parties agree, you can amend the PSR, but not one-sided. Both parties have to agree. Then you can amend the PSR. So in general, in practice, what happens is if there is no dual profit sharing ratio and the customer makes extraordinary profit in one particular quarter, sometimes he comes and renegotiate the PSR, right? That happens in practice. So those are some of the characteristics or some of the key rules or key practices, Sharia practices or Islamic banking practices in the country. So now we move on to the nuts and bolts of Islamic banking, especially looking at the credit side of things. Any questions you all have? Okay. So if we are to look at musharaka from this angle, we look at musharaka partnership to customers in Sri Lanka. It is often offered to high-end corporate segment because the reason is musharaka is sharing of profits and losses. So generally, you need to have you need to be able to validate or rely on the profits or losses of the transaction or the business that you are dealing with. If that is not possible, it is not possible to do musharaka. As such, in general, it is it is mostly offered to high-end corporate segment because the financials are reliable. Financial records are reliable. They don't keep 3 sets of accounts with 3 sets of profitability. So more reliable, easier to look at. Or it is also offered to transaction level musharaka for mid corporates and SMEs, where the transactions can be justified or validated by independent documents. For instance, if somebody buys something from an external party or sells to an external party, which gives invoices or receipts or sale advisors or things like that, then you can independently verify sale. As such, musharaka can be offered. So that is the purpose for which, so generally for business purposes, so we are discussing musharaka under business purpose, except in one case where musharaka can be offered for retail or personal customers, consumers. In majority of cases, musharaka is offered as a business facility. And mostly it is given to the high-end corporates where profitability can be reliably validated. It may be offered to SMEs where there is a way of reliably verifying profitability of underlying transaction. So who to offer has to be a very important, because it's a risky product. Product is risky because we are sharing losses also. As such, this is the current practice in terms of purpose. In terms of amount that can be offered in a musharaka, transaction level musharaka is limited by the underlying value of the transaction. So even if we are giving 99% of the funds, you can still give based on the value of the transaction. As such, it is limited in that sense. So underlying transaction, as common with other types of Islamic finance also, underlying transaction limits the amount of funding that we can give on a musharaka. Musharaka is predominantly offered short term in Sri Lanka, especially because long-term profit and sharing arrangements difficult to establish even with corporates. So often predominantly offered short term. There are, of course, long-term facilities also, but predominantly the pure form of musharaka is offered for short-term period because it's easier to establish records, especially if it is transaction musharaka. Generally it is short-term. If it is at organization level, depends, but generally biased towards the short-term, medium term. So pricing, in terms of return, PSR, that is the profit sharing ratio, is linked to the expected rate. We will see in the question how to do that. So if we have an expected return from a transaction like that, let's say for corporate, we are going to charge 6% or 7%. PSR is designed in such a way that the expected return, we will get around 6 or 7%. Actual returns are based on the performance of musharaka. So actual returns on any musharaka is based on the performance of musharaka. So if we make more profits, we get more return. If we make less profits, we get less returns. If we don't make profits, if we make loss, we get losses. So that's the pricing. So when we are pricing Musharaka, we need to take that possibility into consideration in deciding the profit sharing ratio. In terms of documentation, standard credit documentation from offer letter to the mortgage, you can have. If there is no mortgage, even you can give clean. So standard documentation applies. In addition, Musharaka documentation is also included. So collateral, I just mentioned about clean, guarantee, mortgages. So only due amounts can be recovered. I'll come to that in a minute. Repayment, short-term bullet payments can be made, or it can be profit only and capital edge maturity. That is also common in Musharaka. If there is a need to increase the tenor, that is possible in a Musharaka. So you can reschedule Musharaka because you can continue to charge a return because it is profit based. I think with that we will break for 10 minutes. We will come back at 3:35. Is that okay with everybody? Okay. Yeah, we will continue the rest of the lecture. So essentially, we are discussing. We started the session by defining what is Islamic banking. We defined some of the key principles involved. Then we started discussing one particular type of product, which is partnership or musharaka, right? So essentially, what we said is the types of product used in Islamic banking kind of connects or integrates with real sector economy, right? That's what we said. So in conventional banking, if you look at conventional banking and Islamic banking, the diagram we used for Islamic banking, which is put as IB here, is we invest in a project. The customer also invests, and the returns are generated in the project are distributed. So Islamic bank invest in the project along with the customer. Whereas if it is a conventional bank, gives return to the customer, invests in a project, he gives the returns of the project to customer, and customer in return gives the project to returns to the conventional bank. These two transactions, although are dependent on each other, are treated as separate, right? The transaction between customer and the conventional bank is treated, that is the borrowing on interest and repaying, treated irrespective of the profits or losses generated in the actual project. Of course, even in conventional bank, the returns invariably will be determined by the project profitability of the project. but there is no direct link in this loan mechanism type of transaction. Whereas here, the project is in the middle, and the returns are actually shared between customer and the Islamic bank based on the actual returns of the project, right? So that is what we are starting as when we said we link the real sector and the financial sector. This is what we meant. Each of the product will have some the underlying contract will link the real sector, that is the actual project work in this case, with the bank, rather than just leaving it as a loan transaction with on which we have to pay a return. So when we write about musharaka versus conventional loan, these are the areas that you could think of comparing them, where they are similar in certain instances and where there are differences in other instances. So you can think of it as PAT PDC Rolls-Royce, that is PAT, purpose, amount and tenor, PDC, post-dated check or pricing, documentation and collateral, and Rolls-Royce stands for RR, repayment and rescheduling. That's one way of thinking about it when you want to write about the similarities and differences. We will look at another way of writing as we go on under the question side. I hope this is clear so far. Anyone has any questions, please feel free to ask. Or you can text on the chat messages. So we move on to discuss some of the key risks related to musharaka. And the first being, we have to choose the right customer. We have to choose the right. Second being, you have to choose the right project. And third, we have to choose the right time period. I will explain that. So you have to choose the right customer, because there will be customers who will be having certain businesses will have seasonal products, seasonal profits, all right? If you choose customers like that, whose returns are seasonal, you may end up if you are so first right customer. What we mean by right customer is that you have to choose the customers whose profitability can be verified. If you have three types of profitability, it cannot be verified, you will have problems. If you have very high volatility in profits, it is not possible to do a musharaka, right? Let me explain that on the board. So client A versus client B profits. Year 1, 2, 3, 4. Client A profit is 20 million, 20 million, 20 million, 20 million. Client B profit is 5 million, 35 million, 15 million loss, 25 million loss. Now, if you had to give musharaka to customers, you may prefer customer A against customer B. Customer A, because it is a regular profit, maybe 20, 21, 22. So you would have basically with very little variation, you will be able to tell what the profit is. Whereas in this case, the variation is very high, so you are unable to tell what exactly is the profit next quarter, because there is no pattern or no very high standard deviation. As such, it's not acceptable. It is risky to enter into musharaka with the customer like that. So when you choose large corporates, you have to choose the right segment of customers so that you could minimize them repaying you the capital and the profit. You could minimize the risk of them not paying the capital and profit by choosing the right customer who has profits, or right project which has profit, which are sustainable. Because unlike in a conventional case, even when customer is otherwise capable of servicing your facility, if he is not making profits, Islamic banking side, he is not required to pay you your capital back if he's making losses. So the risk related to giving him a musharaka is relatively high even compared to conventional banking products. As such, it makes sense to choose reliable profit trend, a customer having reliable profit trend, meaning less volatility in profits, a project, a transaction which has less profitability, less volatility, is good to be chosen as musharaka. In case a customer has very high volatility in profits, you may want to consider alternative contracts other than musharaka, right? Other than partnership. That's the first point. Number two, even when customer is having good projects, he may be having 3 projects. 2 projects are good. He starts a new project which may be loss making. So if you enter into transaction specifying the 3rd project, which is loss making, despite the fact that customer overall makes money, he doesn't have to pay anything on the loss making project. As such, bank may lose its capital. As such, in generally, you don't fund a project whose profit history on musharaka basis. You don't fund a project whose project profit history is not reliable, or whose outlook is not reliable. You wouldn't fund it. Third is seasonal variation. I alluded to this earlier. If a company or a project, the profit is related to cyclicalities, some kind of cyclical profits. For instance, if it's a hydropower project and the project is determined by the rainfalls, if you get caught to the wrong period, wrong quarter, where no rainfall and there is no generation, there is no income, you may end up sharing profits. So let me show this in on the board. So if the profits are cyclical, something like this, end of Q1, end of Q2, end of Q3, if you only engage in this particular period between Q1 and Q2, where the profits are below zero, meaning losses, you will share losses only during this period. If you enter a musharaka only for Q1 to Q2, you will end up sharing losses. As such, the period, if the business is cyclical, it doesn't make sense to share profits. Only for that cycle. So if necessary, if you need to lend to that customer during that period, if you need to give a facility to that customer, it is best to cover longer tenor, so that overall profit of the 3 tenors could be added. Otherwise, you will have the risk of losing the capital. Right? So those are the basic parameters of a musharaka transaction, which we need to consider in understanding how to give a musharaka and what are its key risks. Any questions you all have, I'll be very happy to answer. Otherwise, we move on to a question which we can do together. Anything you all have, please feel free to type or talk. Okay. Not too many questions, so I will go to the question. This is not there in your slides. You may want to take a screenshot or write. I'll give you 5 minutes, maybe, to quickly look at it. I'll put full screen so that you can look at it carefully. So this is the type of question that you can expect at exams, where the question will be asking broadly about Islamic banking, maybe to start with, then definition of what a musharaka is or something like that, and then goes on to check whether you understand the application of musharaka, that is partnership, in a small business transaction or business in a business scenario, right? So these caselet help us to understand the application. Although we talk about the principle, how is it in practice applied is what these caselets explain to us, right? So let's try to work that out. I expect you all to do it so that you will understand where you are getting stuck or where you are not clear about. And then if you follow me when I'm doing the question, it'll be, the clarity will be much more rather than just looking at what I'm doing or auditing my calculations, because that may be more you will understand where we could get stuck. So if a question like this comes for the exam, for instance, you will know what to look at. Right, so let's read the question and try to understand it. So the question is, Star Brothers is a registered commodity exporter and is a regular customer of your bank. Senior partner Mr. Shah approached your bank's Islamic banking division for a facility and informs you the following. 1. They intend to purchase 25,000 kilograms of tea at the next week's auction at an average price of 250 rupees. So first thing it says is that they intend to buy 25,000 kilograms of tea at 250 rupees per kilogram. All right, that's the first point that the question says. He is confident that the tea can be sold at an average price of 310 per kilogram in 3 months' time. And he could settle the facility in full in 3 months' time. So he can sell this at 310 rupees, sell at 310 rupees. Okay. He can allocate LKR 2,250,000 for the purchase and requires the balance from the bank as a Musharaka facility on a PSR basis. Now, note two things. One is 2,250,000 is what he is going to contribute. This is the customer's funds. Customer is going to contribute 250,000, 2,250,000, right? Number two, the question is silent on what is meant by PSR, right? We all know PSR means profit sharing ratio. Profit sharing ratio. But sometimes it keeps quiet, the question, because in 3 months' time, when you sit for the exam, you may forget that. PSR means profit sharing ratio, which is pre-agreed before the transaction happens, before the Musharaka transaction, at the onset of Musharaka. We agree what it is. It's a ratio, all right? So customer comes and says, I'm okay for Musharaka facility. Give me on a PSR basis. Bank has primary mortgage over a commercial property owned by Mr. Shah worth 10 million. So bank has primary mortgage. So actually the total transaction, total value of the transaction is $6,250,000 is the value of the transaction. That is, if you buy 25,000 kilos of tea at 250 rupees per kilogram, you will end up, you will need 6,250,000 in total to buy this tea next week. All right. Of that, the customer has 2,250,000 rupees. Right. Everybody clear? Any question, please speak up. The bank has property mortgage over, the bank has a property mortgage over the commercial property of 10 million rupees. Everybody can see. So we are using the board now to do the question. If you want, I can put it up for a screenshot. Anybody wants the question again? We gave 10 minutes to look at the question. Anyone has trouble, please text or speak up. So we are looking at the total amount that will be required is 6,250,000. The customer says he has 2,250,000. So what he is expecting from the bank is 4 million rupees. The difference. Yeah. So this is the bank's amount. So specific transaction amount that he is looking for is around 4 million rupees. Sorry. The bank has primary mortgage over the commercial property owned by Mr. Shah worth 10 million rupees. Currently, there are no other obligations to the bank from any of the partners of Star Brothers. So that is about the collateral. Already it has 10 million rupees. Required, the first question is, what is a Musharaka facility? So you need to define a Musharaka facility to start with. That is the first question. So even if you don't, if you can't remember the whole definition, at least to say it is a Islamic banking facility to start with, because that is an obvious answer. Say it is an Islamic banking facility. Of course, you remember Musharaka as partnership. So say it's based on partnership and the characteristics of partnership. By reading this, you will understand. So characteristics include, you define the capital. Capital is contributed by both parties. Profits is agreed on a pre-agreed profit sharing ratio, that is PSR. Losses are shared based on the capital contribution. And management and dissolution, right? These are the factors we discussed. So when you are discussing defining Musharaka, you can define based on purpose is generally for purpose, capital, profit, losses, profit, losses, management, and dissolution. Purpose, capital, profits, losses, management, and dissolution. So these are the factors you can include in your answer for a comprehensive answer. But even otherwise, if you can say it is a Islamic banking facility based on partnership, that is something to start with, right? So you should be able to write that as a start. And if you can draw the diagram where both customer and the bank invest in a project, share profits and losses, that is even better. Right. Now the second question is calculate the PSR to be proposed to Star Brothers. Now the question is calculate the PSR to be proposed to the Star Brothers, assuming customer statement is reliable. Now customer made a statement with 3 bullet points on top. Now that is reliable from the bank's perspective, so that is even better. So you don't have to worry about its validity. It is valid. Calculate the profit sharing ratio PSR to be proposed to Star Brothers, assuming customer statement is reliable and the expected rate by the bank is 12% per annum on this facility. So customer statement says he needs 3 months facility. He needs 3 months facility, 3 months facility, right? Expected return is 12%. Okay. 3 months facility, expected return is 12 months. Now we need to work out what is the profit that is expected in this transaction. Of that profit, how much share we should take. So let me erase this. So in order to first calculate expected return, 4 million into 12% into 3 months is what we are looking at as absolute amount, right? Did I get this right? 4 million, 3%, 1%, 400,000, 40,000, 120,000. So the expected return is 120,000. How did I arrive at that? 4 million into 12% into for 3 months. The question says 3 months he will settle. Yes. So the total expected return from the bank for the bank is 12,000 rupees, right? But the expected profit on the transaction is total sales amount is 25,000. Total sales proceeds is 25,000 into 310. The selling price is 310. Zero, 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 25, 2, 25, 75, 77. So total sales proceeds is 7,750,000. The cost of sales is 6,250,000. $6,250,000. මට මේ මාකර්ස් දෙකක් එවනවද ප්ලීස් මේ whiteboard marker So sales is 6,750,000. The cost is 6,250,000. The profit is 1,500,000. Hopefully this is right. Anybody who gets a different answer, please let me know. Not using any calculators. So the other way of checking is, of course, 60 rupees per kilo into 25,000 kilos. Yep, 1,500,000 rupees is the answer, right? So that is the total profit. Of that, we need 120,000 rupee profit. Of the 1,500,000 rupee profit, the bank needs 120,000 in this transaction. The balance is for the customer. So customer will get 1,380,000 profit. Bank will get 120,000 profit. Altogether, you get 1,500,000 profit. So the ratio is 1,500,000, 1,380,000 divided by 1,500,000 is 92%. 92% for bank, 8% for the customer. So it makes 100%. So the profit sharing ratio to be proposed is 92:8. Customer is to bank. That's the answer to question number 1. How did I arrive at it? Let me go through it again. Let me go through it again. 25,000 kilograms is being bought at 250 rupees per kilogram. So altogether, the customer is planning to buy 6,250,000 rupees worth of tea in this particular scenario. And the tea, to buy all that, buy 6,250,000 rupees worth of tea, the customer has only 2,250,000 rupees. He is expecting 4 million from the bank, and bank has no problem in giving that funds based on what is told in the question. So bank is interested in giving him for 3 months at an expected rate of 12%. Now, unlike in a conventional bank, we in a musharaka, we don't say pay us 12%. It doesn't make sense. Then we go back to the unlike in a conventional bank, we don't go to the we don't say 12% pay me. Then it is like it is almost similar to the Islamic the conventional banking transaction where we lend based on a pre-agreed return. Here, what we are doing is we are entering into partnership with him. So in order to enter into partnership, we have to look at what he is going to sell this price at. So the expected profit, and based on the expected profits, we get our share of profit, and that share of profit should be based on our expected rate of return. In a banking setup, your treasury or your head office will normally tell you, for a 3-month facility of this great customer, this is what we are looking for in terms of return. with this type of security. So that is your rate sheet. Generally, it will be available from the head office or from treasury or from your regional office. You will have that. So based on that, this 12% is derived. It may be based on the benchmark, right? It may be based on SLIBOR or the AWPLR or whatever rate. So that is given, but you don't tell that to the customer. You tell to the customer for the purpose of Musharaka, what is the profit sharing ratio you are looking at. The question says customer is reliable. The information he is providing is reliable. As such, we agree that we can give him we can assume all these numbers are reliable. So we use these numbers to calculate the expected return. So if you give 4 million rupees for 3 months at a rate of 12%, you will expect 120,000 rupees in return. Now that calculation is simple interest rate calculation, right? But having calculated that, that is your expected profit from this transaction. So there is no guarantee you will get this profit, right? I will come to that and explain that in a minute. In the next question, right? Second part of this question. But for the moment, you work out what is your expected profit. And if it is reliable, you work out the profit that this transaction is expected to generate. How do you generate the profit on this transaction? Is buying the tea at 250 rupees, selling the tea at 310 rupees. So per kilo, he is making 60 rupees per kilo. For 25,000 kilos, he makes 1.5 million rupees, right? 60 rupees per kilo, 25,000 kilos, 1.5 million rupees. That's the total profit in the transaction. Of that profit, we will take 120,000 rupees. Balance is for the customer. Of this profit, 1.5 million, we take 120,000 for us. That is, the bank takes 120,000. The balance is for the customer. So to calculate the ratio, total profit, bank's profit is 120, balance is customer's profit. If you calculate the ratio between 1,380,000 and 1.5 million, it is 92%. The bank's 120,000 divided by 1.5 million is 8%. Together it makes 100%. So the ratio is 92:8. That is the right ratio to propose to the customer, provided all the information he has given is right. So this is at the outset of the transaction, not after the completion of transaction, based on the expected profit of the transaction. That's what we are doing. Is that clear? Any questions? Any questions? Okay. Let me continue. So we propose to the customer 92:8 as the profit sharing ratio in the transaction at the outset of the transaction. So we said profit sharing ratio has to be agreed, pre-agreed. This is what we agreed. So the second question, second part of the question is, let me see this. Assume PSR agreed is 88:12. Now, next to the profit sharing ratios, this is also very important when you write answers. When you give profit sharing ratio, you have to write, let's say, 88:12, and next to that, within brackets, you say who is first and who is second. Now, 88 belongs to who? Customer. 12 belongs to who? Bank. Now, so instead of this 92 and 8, when the bank's rate sheet says 12%, right? the person in front, let's say he's a young advanced diploma student, he, instead of calculating all this and putting, he saw the expected rate is 12%, so he put 88% for the customer and 12% for the bank, right? 88 to 12, not, yeah, that is the, assume the PSR agreed is 88.12 and the customer sold all the TN 310 and settled the bank in full on 90th day. Calculate the effective rate. Now, if instead of calculating all these, and in some Islamic banks, if you get a screen where you can put Musharaka profit sharing ratio, and if you mistake the ratio for the percentage return, you will end up, instead of putting 92.8, you will put 12 for this, so that customer share will become 88 automatically. So the question is 1.5 million profit. Customer and bank, customer will get 88 and bank will get 12. So the question is, how much is that? So 12% of that is 180,000, 150,000 and 30,000, 180,000 for a facility of 4 million. For 3 months. So this will be the effective rate. So effective rate will be 18%. So how did I arrive at it? This profit we calculated earlier. This is the agreed PSR as per the question 2. 12% of this is 180,000. We earn 180,000 by giving a facility of 4 million for 3 months. So the effective rate is 18%. See how the effective rate has changed. Originally it was 12% is the expected rate. Because we agreed on the wrong profit share, or the profit share we agreed is higher than what it should be. Ideally, if you are to get 12% profit share, 12% returns, your profit share should be 92 and 8 for the bank. Instead of 8, if you put 12 there, you will end up getting higher return. That's what this question shows. Any clarifications on that?
Excuse sir.
Yes.
180,000 for 1 year, no?
Yes.
Why did you divide by 3 and into 12? Then
no, the facility is for 3 months.
Yeah, but if we for 3 months we are getting only 45,000, 180,000 for 1 year.
Yeah. So this is in per annum, 18% per annum. The 18% is per annum, no? Earlier the 12% is per annum.
Yeah.
Now I am telling per annum 18%. That's what I'm saying. Yeah.
Yeah. Okay.
Right. So if we mistake the percentage, the not mistake the original request, first question is to calculate the profit sharing ratio to be proposed. Second question is, if we propose a profit sharing ratio, how does it work out in terms of expected return, right? Let's go to the third question. Assume PSR agreed is 8812, right? So this is the PSR we agreed. And the customer sold only 15,000 kilograms of tea at 310 rupees. So instead of selling the entire tea, customer sold only 15,000 kilograms. So 25,000 kilograms of tea, 15,000 sold at 310, balance 10,000 is not sold. 310 means 60, 0, 0, 0, 0. So for the amount of goods sold, we have a profit of 900,000. That is, for 15,000 kilos, we have a profit of 900,000. But we gave a facility for the full 25,000 kilos, and we agreed it will be settled in 3 months. That's where we worked out our rate for. Our profit sharing rate was worked out in the first question. We worked out based on a 12% return, we worked out 92:8. In this question, let's say we are expecting 18%. But after 3 months, at the end of 90th day, customer comes and says, I'm sorry, Mr. Manager, I'm unable to pay you because I haven't sold the goods. Now this is the unable, not that I'm unable to pay, I haven't still sold my goods. Now the rule is, the Islamic banking principle is that he needs to the profit needs to be agreed or calculated or realized for us to share profits. If he says I have goods, we need to have a mechanism of exit. So there are two or three ways in which we can handle it. One, the first is mutually we can agree today's market price is this for this type of goods. As such, we will calculate profits based on that, and we will complete the musharaka. That is one. So if you can establish a market price, even if you don't sell, you can mark to market that price and calculate profit and split the profit and loss. So if on this particular date, the profit is mark to market price is 310, you can agree for that price and you can split the profit and loss profit accordingly. So agreed price is customer sold only 15,000 kilogram by 90th day. Discuss the options available to bank from a credit perspective. So the option available to bank is to agree on a mutually agree. One option is to mutually agree on the price. In the Musharaka agreement itself, as one of the conditions of Musharaka agreement, which is defined by the tenor, that is in this case 90 days Musharaka, you have a clause which says in case goods are not sold by the 90th day, the market value of that good will be mutually agreed, and the profits will be calculated based on that. So that can be one way of looking at it. The other is to delay. Other is to reschedule the facility for another 30 days and allow the customer to sell at whatever market price and recalculate the profit. Now, if you want to do that, you have to take into consideration some additional profit sharing ratio so that the delay can be priced in. Let me repeat that again. If your expected rate is only 12%, and you agree for 92 for customer and 8% for bank, you will not have any additional buffer. If he sells after one more month and comes to you at the same price, of course, you cannot earn more, right? Because even after 1 month, if he sells at 310, you will get the same answer that you got previously. That is 120,000 or around 120,000 for the bank, right? If you agree at 92.8. But if you keep a little more profit sharing on your side, in case of a delay, you could charge more. So unlike a conventional bank, if a customer delays, there is no penal rate that you can charge in this situation, right? So when you are agreeing profit sharing ratio, it makes sense in order to protect your profit to have a buffer favorable towards the bank. So in case customer delays or based on his behavioral pattern, you agree you will mark 3% more, or instead of 12 to 8 to 92 to 8, you will make 88 to 12 in order to cover for that possible delay. That is one way of adjusting the profit share at the outset, right? Otherwise, if a situation like this comes, you will not have any room to adjust for that delay, especially in a transaction-based musharaka. If it's an organization-based musharaka, of course, you can charge profit for the whole year or whole period. But if it is a transactional-based musharaka, it always makes sure to build in some buffer into bank share of profit in case the customer has a delaying pattern, or in case there is a possibility of delaying pattern, right? So however, it is a mutually negotiable thing. Otherwise, if customer is a regular payer, he will say we are charging more than what we agreed, right? So it has to be mutually agreed, but that gives the buffer for the bank to charge. So that is the second option. So you delay but charge for the extra if there is room. Otherwise, of course, you mutually agree this is what the value is, and based on that value, you calculate profits and exit the musharaka. Right? That is those are the two main options that one could think of when you are dealing with delays in customer not selling the goods, especially in a transaction musharaka. What I mean by transaction musharaka is we give facility for profit sharing for a particular transaction, right? We don't share the profits of other transaction. As such, even if the customer has money, he will not be able to pay us because the transaction that we have given money for does not involve sharing profits from something else. So that is question number 4. Question number 5 is calculate the profits or losses to the bank if agreed PSR is 78.22 and if customer sold all the tea at 25 rupees. Anybody who has done this question already? Question part number 5, anybody who has tried? Would you like to share your answer, please? Nobody? Questions 5th part, anybody who has done, please share the answer. So here is an important tip. I started by saying profits are calculated based on profit sharing ratio. Losses are calculated not based on profit sharing ratio. Losses are calculated based on capital contribution, right? In this case, in this case, 4 million in this case 4 million from bank, 250,000 from 2,250,000 from the customer, 6250. Bank shares 64% and the customer shares 36%. This is the loss sharing ratio. This is not pre-agreed. This is agreed based on the capital contribution. If bank contributes 4 million, which is 64% of the capital, it should share 64% of the losses in case loss comes. Now, in this setup, in this question, the loss is sold. The tea was bought at 250 rupees. 250 rupees. Tea was bought at, sold at 225 rupees, bought at 250 rupees. Per kilo, the customer makes 25 rupees loss. 25,000 kilos. So customer makes 625,000 rupee loss. So that loss needs to be shared based on the loss sharing ratio. So per kilo, the customer makes 25 rupees loss. Since 25,000 kilos are there, total loss customer makes is 625,000, right? 625,000 needs to be split based on 64/36 percentage, which will work out to 400,000 loss for the bank and 625,000 loss for the customer. What does it mean? It means first, so general mistake, common mistake when attempting the Musharaka question is that when a loss comes, we also use the profit sharing ratio to distribute loss. That is the first mistake. So you need to first calculate, in case of loss, you calculate loss sharing ratio by reference to the capital contributed. If the capital contributed is established, then you take the total capital divided by the bank's capital, you will get the bank share. Total capital divided by customer's capital, you will get customer share. Based on these two, distribute the loss, calculate the loss and distribute. Is that clear? Any questions? Okay. So what does this loss mean? What does this loss mean? Bank shares 400,000 loss means bank gave 4 million rupees capital. Bank's share of loss 400,000 means customer comes back to the bank and settles 3.6 million and says, thank you very much, I really like Islamic banking. The reason being, loss means loss of capital, right? So customer does not have to pay the original amount he borrowed or he took facility from the bank. He pays less than what he originally took. So it is a very unique feature, and it's not a feature if it happens frequently or even less frequently. It will create a lot of trouble. So as such, it creates question marks. So this is why Musharaka is one of the riskiest products, because if we don't identify the right sector, if you don't identify the right client, you will end up sharing, the bank will end up sharing losses, and losses means the customer does not come and settle the capital he took. Forget about the returns, not even the capital he took. As such, it's risky product because the returns can be negative also, which is in conventional banking, you wouldn't hear about anything like this. Sharing losses. Not that customer is delaying or defaulting. He will come to the bank, thank you very much. He will profusely thank you and say, I'm settling my loan with all the returns, but is the return negative return? So we will end up getting less than what we gave out as. Yes? Is there a question? Okay. So this is not a very good situation. So that's why Musharaka is one of the highest, riskiest product. There is only one product which is more riskier than the Musharaka. So it is risky for when the bank is, that's why we need to choose the right customer, you need to choose the right time period, and you need to choose the right product so that you don't end up sharing losses and reducing your capital. Sharing losses means loss of capital. So that risk we need to consider in our credit appraisal process. We need to consider that in our credit monitoring. When you have given facility on Musharaka, your monitoring should be that much more frequent, because the related risk is high. What is the risk? Not only that he will pay you lower return, he may end up paying you less than what he borrowed, right? Borrowing in the sense, let's say, less than what he took as the original capital. In order to identify that, you need to identify the sector you want to be in. This is the sector you want to be in. If you are not comfortable with those questions, that is, I'm not sure whether he's the right customer, I'm not sure whether he is in the right profit cycle, the best thing for you to do is look at for alternative mode of financing than musharaka. Right? So if you are a credit manager, you sit in a credit committee, you sit in a credit appraisal discussion. If a proposal comes from your CRM, if your business branch manager, if your business guy brings in a proposal and it is musharaka, carefully look at whether you could look at any other alternative products also, because musharaka may be on the higher side of risk. High side of risk in the sense, if the project goes into loss making, you may end up sharing losses, right? So that is what the take home. If you are doing, it doesn't mean we don't do musharaka, we do musharaka, but with selected customers, with established product history or project history, which established records, so that the variation in profits are managed, right? Variation in profits, especially losses, are managed. So if you generally share profits at a gross profit level of an large organization, which will have reasonable gross margins over the years, chances are you are unlikely to go wrong, right, at organization level. But if you do at transaction level, something goes wrong here, you will end up sharing losses. So that is the risk you need to be aware from a credit perspective, and that is what that is the eye you need to that is the view you need to look at in the CRM, in the credit memos. That is what you need to look at and see how this can be mitigated. Of course, without history, without actual profits, you cannot mitigate, because that is an inherent risk to the product. And that needs to be managed only by looking at a reasonable level of profit share. So one way of monitoring it, instead of having exact profit share, you buffer it up. You buffer it up so that in case of delays, you can handle. But when the price goes negative, you have that risk that cannot be buffered up in the profit sharing ratio, because losses are shared based on the loss sharing ratio. Any questions on that? Anyone having any questions? Good. So the next question. Based on the above answers, discuss from a credit perspective how a musharaka facility is different from conventional loan given for that purpose. So how is this musharaka different from a conventional loan? Now we have discussed so many features, you can write about it, but you need to remember so one way of writing about it, you can say nature of contract, nature of contract, purpose, profits, losses, so musharaka, partnership, conventional loan. Nature of contract is partnership contract. This is a loan contract. Purpose is for business transactions. Generating profit. This can be given for any transaction. Loan can be given for any transaction. It doesn't have to generate profits. Profits are calculated based on pre-agreed profit sharing ratio. Losses based on capital contribution. Returns is interest. Is charged. No concept of losses. Let me read it for you. So nature of contract, how is it different? Musharaka, nature of contract is a partnership contract. Purpose is for some profit-making transaction, business transaction. The returns or profits is based on a PSR, losses based on capital contribution. On the loan, nature of contract is a loan contract. It can be given for any purpose. It doesn't have to be business or profit generating purpose. The returns charged is interest. Losses, there is no concept of losses in the conventional law. So at least few pointers like this you can add on here are the key features which you should be able to write when you are reviewing. The similarity, of course, with the conventional loan is that unlike in the same way we can take a collateral for conventional loan, you can take a collateral for permissible. You can take a collateral for Musharaka also. But when you are going to, in case customer defaults, you want to crystallize the collateral, how much can you recover is depending on the amount due. Permissible, but you can recover only amount due, right? In the second case, in the last case where there is loss making, let's say customer defaulted and we have 10 million worth of his house mortgaged to us or property, if the question says something like that. Bank has primary mortgage over a commercial property owned by Mr. Shah worth 10 million. Let's say we went for action, parate action, everything else failed, the customer defaulted and all that. And in case of question number 5, where we lose 400,000 minus 40,000, right? 4 million minus 400,000, correct? 3,600,000 is the amount due. Let's say we have a property which is worth 10 million, we sell it for 9 million, let's say. Even when we have 9 million, although we have given a facility of 4 million, as long as this is a genuine business loss, we could only recover 3.6 million from the customer. There is no penal interest we can charge. There is no profit rate we can charge other than the administrative cost or legal costs related to recovery. We cannot charge anything more from the customer. Only what is due in case number 4. Case number 4 is 3.6 million. In case number 2, maybe more, right? But the point is the collateral, whatever collateral we we take in a conventional loan, we can take it in Musharaka also. The difference in collateral comes when we go to crystallize is we will be only recovering the amounts due to us in terms of Musharaka capital and profit. Musharaka capital minus losses in case of losses, plus any administrative cost. We cannot charge anything more. There is no concept of penal interest rates in Islamic finance, so we won't be generally allowed to charge anything more than what is agreed on a Musharaka basis, right? There are instances where we can charge a penalty. We will come to that as we move on. But in general, in Musharaka, we will be charging what is due. If in first case, if there is a profit of 4 million, capital of 4 million and a profit of, let's say, 120,000, and the customer goes bankrupt or customer defaults, and we get crystallized our security, we can charge 4,120,000 from the sales proceeds, right? Plus whatever our cost. Otherwise, in case of losses, what we can recover is what is due to us, and in this case, what is due to us is only 3,600,000. Is that clear? Any questions on that?
Excuse me.
Yes, go ahead.
Can you explain the 4 again? Number 4.
Number 4.
Yeah.
Okay, sure.
Yeah.
Customer sold only 15,000 kilos and 90th day. Yes. So what we just discussed is that there are a couple of options. One is to mutually agree with the customer in the Musharaka agreement itself, in case on the 90th day it is not sold, or if there are goods remain in inventory, the market value of the good will be what is used to calculate profit. And based on the market value, it's like mark to market in financial markets. You agree based on that value, you calculate profits. That is one way of going out, right? So you say in previous case, it was, let's say, 310 rupees was his last transaction, but the balance he couldn't sell on the 90th day, 91st day, 92nd day, he couldn't sell. He comes for settlement, as in he comes to settle the facility. You say, since you have sold last week or 2 weeks before, 3 weeks before at 310, we will assume the value of the rest of the stock is also 310, and let's calculate profit on 310. So you calculate for the whole as if the entire stock is sold at 310, you calculate profit and go ahead. That can be mutually agreed. So what we are agreeing is the value of the stock, which we are going to transfer from us to the customer, and we are going to calculate profit on that. That's one way of doing. That is one option. So one option available for us. The second option is, of course, to give him more time to sell. But if you are giving more time to sell, either you should have little more buffer in your profit share to cover for that extra time. So if it is, let's say, we are giving him 1 more month, if you keep the profit share at the same rate, in original case 92.8, you won't get the 12% expected return you got, right? Because this will get diluted. This may become like 11% or something like that. Because if you are using the same profit sharing ratio, instead of selling everything in 3 months, if he sells everything in 4 months and gives you the same amount of profit, your effective rate will come down. So either you have to accept it, or when he's coming to renegotiate the number of months when he can settle, you can say, since both of us agree you can't sell it now, we will extend it to you for 1 more month, but we will extend the profit sharing ratio. We can share the profit sharing ratio based on this. You can propose a new profit sharing ratio. Alternatively, at the outset, when you are proposing a profit sharing ratio, add some buffer so that in case of delay, you have enough buffer to, without going to negotiate, you have enough buffer to manage that also. So both ways you can do. Is that clear?
Yes, sir. Thank you.
Okay. So I think we have covered the question in total. So this is what we will be looking at when you go into exam. A question like that will be a typical question, right? It doesn't mean exact question will come, but this is something you will face along with something to write, something like what do you understand by Islamic banking or things like that, and then you will have a question, a small scenario in which you have to work out multiple questions, making profits, making losses, how you could manage the credit aspects, what kind of risks we face, where bank has to be more careful, how it compares with the conventional bank. These are the type of questions we get. So as long as you practice something like this, a full question, and so it will give you an understanding of application of musharaka. So when I started saying the first product is musharaka, and I gave you in principle explanation, it may not be very clear, but when you do a question like that, like this, it's much more clear what we have in mind and how in practice. Of course, this doesn't give all the details of a facility, but it is the most summarized version of an actual transaction, right? So if you have this basically in your mind, you should be able to, bet a question on musharaka in the exam paper. Anything else you all want to clarify before we move on to the next product? Okay, good. So what we have demonstrated so far is that to give facilities, one way is to give a loan and say you pay interest and get interest, although we will evaluate the underlying requirement, underlying purpose, the character of the customer, all that. The tenor, he requires it, his financial records. This is another way of giving facilities to a customer where we share profits and losses. Still, we can earn a return. So when we said Islamic finance is interest-free, not cost-free, so when the customer obtains a facility from the Islamic bank, he has to pay a return. He has to pay 120,000 in the first instance. But the underlying return is structured in a partnership, similar to a partnership, where we share the profits, and in case of losses, we share the losses. So that underlying benefits or risks of the real economy gets passed on to the Islamic bank, rather than just monitoring the underlying economy, but we recover our own our own returns, irrespective of actual returns. Rather than looking at this is one way of doing it. But I have to remind you, this not all the Islamic banking transactions are profit sharing transactions, right? There are other transactions which we will look at. That's what we are going to look at now. But all the transactions, none of the transactions are loan-based transactions. So you could generate returns by using these transactions, which have been there for a very long time. Partnership, all the traders, all the businesses know the features of partnership for a very long time. So we could use any of these contracts to generate return and give facilities and for bank to make money without essentially limiting itself to interest-based transactions, right? So we move on to the second type of transaction, second type of product, which is called mudaraba, right? So it is also a special type of partnership. So mudaraba is also a partnership, but it's a special type of partnership. So earlier when we discussed partnership, I said there is only one product which is more riskier than musharaka, and that product is mudaraba, which is special type of partnership, right? So this is actually a variation of the original partnership. So let me explain that to you. So in mudaraba, that is a special type of partnership, there are two types of people. One is people who provide capital. The other is people who provide expertise, right? Two types of partners. One partner provides capital, the other partner provides expertise. So it is marrying, or it is putting together. So in any economy, you will have people who have skills and who are willing to take risk, but lack capital. There will be other set of people who have capital, who have funds, but don't want to, don't have the expertise or don't want to put in the effort. So bringing them together is good for economic activity, economic growth. So putting them together is the original purpose of a partnership like this. So originally, in the setup of a let's say of those time period, people were very scared to travel. People who have money were very scared to travel because travel was a dangerous thing, because you can get robbed, you can get killed, you can contact diseases, all sort of, you can be attacked by animals. So people had money but didn't want to take the risk of going and doing business. There were other set of people who had the expertise to travel but didn't have funds. By creating an arrangement between both parties, you could create a economic arrangement where both parties could benefit. So that's the origin of the concept called mudaraba, which is a special partnership. So how is it different from musharaka, which is a standard partnership? Is that in mudaraba, only one party contributes capital. In musharaka, which is standard partnership, both parties contribute capital. So let me write this on the board. Special partnership, capital contributed by one partner is known as fund provider. Capital contributed by one partner doesn't mean only one set of partners. They contribute capital. They don't contribute expertise, right? Other partner expertise or management, one partner, he is called fund manager. He's the fund provider, he's the fund manager. And they engage in profits. It's same as the previous case. Pre-agreed profit sharing ratio, right? Pre-agreed profit sharing ratio. Losses based on capital contribution. So who shares loss in the Mudaraba? The person who invests capital, fund provider, shares the loss because he contributes 100% of the fund. The expertise provider does not contribute fund, right? As such, all the losses are shared by one partner who contributes capital, right? What does that mean? If you use it as a facility, if bank gives capital based on Mudaraba, the contribution of capital by the customer is how much? 0%. That is zero equity from the customer into the project. That's what it means. If you see a CM which says the bank will provide Mudaraba based funds to the customer, what it means is that customers' contribution towards the project is zero and no credit. In general, credit team wouldn't like such an arrangement, right? Because it is high risk. After we disperse, we are at the mercy of the customer because we take the entirety of risk. So any proposal would be better than just giving fund based on Mudaraba to the customer, because customer does not contribute anything on his own into the project. As such, this is the most riskiest project for the bank to give funds on, riskiest product for the bank to give funds on. Of course, it has its uses. On selectively it is used for maybe selected customers on specific projects, on specific transactions, involving maybe some government transactions or something like that on selective basis. But it is one of the highest risk that bank could take, because any action from the customer that would create risk to the profitability of the product of the project, that will give negative returns to the bank without creating any returns to the customer, any negative returns to the customer, because he has not contributed any capital in the project. So as such, this is the highest type of cost, highest type of risk in the lending projects of the lending product of the Islamic banks. So in case you see a proposal that comes to you when you are in credit, which says we want to give Mudarba to customer, unless it is very essential, unless you have absolutely no choice. If I were there, I would any day try to convert into a Musharaka type of partnership where customer also contributes a part of the funding so that we have at least some risk mitigator, right? That is the risk levels, because capital is contributed only by one partner, and if we are lending, we are contributing that. Customer only provides expertise. So PSR will be like Musharaka. PSR will be like Musharaka, meaning profit sharing ratio will be like Musharaka, but losses are borne by the capital provider, in this case, the facility provider. So it is risky for us. We move on to the second slide. We have 5 minutes more before we complete, so we will try to complete this and move on. So I have not covered in detail Mudaraba. As long as you understand what Mudaraba is and the risks involved and key features, that is the capital who provides, the expertise is provided by whom, the profit sharing ratio and loss sharing ratio. And you should be able to write the difference between a Mudaraba, a special partnership, and a Musharaka, which is a general partnership. And the difference is what? Difference is in contribution of capital. In contribution of capital, both the customer and bank contribute capital in standard partnership, standard Musharaka. In Mudaraba, only the bank contributes capital. Only one partner contributes capital. As such, it is high risk. So stemming from that difference, the second difference is in case of loss, both partners take loss based on the capital contribution ratio in a standard Musharaka. When it comes to Mudaraba, only bank takes the loss because bank is the provider. Only one partner takes loss. So given those two differences, if you are able to write between a standard partnership and special partnership, you have reasonable understanding of what it is for the exam purposes, right? So in practice, Mudaraba is used not to give funds, but to accept funds by banks. So banks accept funds on the principles of Mudaraba, but that is outside the scope of our discussion today. So we won't be focusing on that. That's what it is used. The Mudaraba principle is used in Islamic Bank mainly to accept funds from the customers and share the profits accordingly. So with that, we will conclude for the day. We will cover the balance in the next session. So all the very best to you all. And if there are any questions, I'll be more than happy to answer. Otherwise, we can conclude for the day, and we can meet next week.